Good afternoon, everybody. Thank you for joining us. Churchill Tax Advisors monthly tax investigation update. If you're watching live, you're very welcome to be here today. Thank you. If you're watching the video recording, trust you will enjoy the talk today and find it useful. Without further ado, let's start with our presentation. So again, it's myself, Dave Jennings, ex-HMRC, Inspector of Taxes, 30 odd years experience on both sides of the fence, 15 odd years with specialists on investigations and disclosures, and my colleague Dane Skeever, who's also ex-revenue and worked for a number of specialist firms, top 10 firm of accountants. We've both got bags of experience of dealing with enquiries and disclosures. So today, we're going to cover property taxes, if the revenue open inquiries, or if you need to make a voluntary disclosure. And what's that all about then? We're going to cover how to fix some of the problems, some of the pitfalls and issues around property accounts, and what that means, and briefly on SDLT, ATED, and private residence, which we're seeing a number of queries around private residence relief at the moment as well. So over the last few years, HMRC has been opening a lot of investigations on property income. They've got bags of information to hand. They have land registry information. They have council tax information. They've maybe got housing benefit information for tenants. They've got information from letting agents. There's lots of information that the revenue collate to find out about either landlords or people selling second homes, investment homes for capital gains tax as well. They either open an inquiry, and in the worst case, if something is a big portfolio of properties, and I have seen this in the past, they could even prosecute cases for tax evasion. That's quite rare. Not many cases do that. Normally it's a civil case. That might be a Code of Practice 9 investigation and inquiry, where you get an immunity from prosecution, providing you make full disclosure and settle with HMRC. That can also be a voluntary Code 9, where you get an immunity from prosecution in the more serious cases, but there has to be an admission to fraud, deliberate behaviour, in order to obtain that immunity from the prosecution. If it's not such a serious case, then the revenue may open an inquiry, or they may issue what's known as one of these nudge letters. That's where the revenue think they've got information and tax returns are maybe inadequate, and they're asking people, check your affairs, make a disclosure if they're wrong, let us know if there's no adjustments. And the main thing for that for UK property is the Let Property campaign. We've dealt with dozens and dozens of cases over the years, hundreds over my lifetime, under the Let Property campaign, where it's a specific disclosure facility that HMRC has, and you have registration, self-assessment, including interest, penalties, calculations of the duties, and the revenue review accept or ask some questions. Most of our cases are usually accepted by HMRC. If it's foreign property and other foreign income, it's the worldwide disclosure facility. That's appropriate. We've covered that in other talks. Have a look at our other videos. We'll probably cover it again in the future as well. That's for UK tax resident individuals with offshore property income or other assets. Use the worldwide disclosure facility. So there are those opportunities for responding to a nudge letter or making a purely voluntary disclosure for HMRC. And we would always say, go to the revenue first before they come knocking on the door, reduces your penalties, sleep at night, move on, case sorted out. Dane will now cover a bit on the expenses that you can claim with property income.
Thanks, Dave. Yeah, so when it comes to expenses incurred on properties, there are a variety, and it's important to understand the different treatment of them. On the slide there, you can see we've got a selection of some of the common items of expenditure that will be incurred. either when acquiring a property or when maintaining a property. Generally speaking, to get relief against the rental income, any expenses must be revenue in nature, i.e. not capital, and they must be incurred wholly and exclusively for the purposes of that rental property. When acquiring a property, obviously the cost of the property itself is capital, but those costs associated at that time as well, so the kind of the professional fees associated with it, stamp duty, they would form part of that kind of capital expenditure. They would not be relievable for calculating any profits, but where you would get relief for those is when you come to dispose of the property. That would reduce your capital gains tax bill. Generally, the running costs of a property fall more within that revenue category, where you would get relief for them, and that would include things such as repairs, kind of your annual safety checks, if you've got a letting agent, their fees, accountancy fees for assisting with filing your kind of rental accounts and tax returns. So those things are kind of what would be allowable. With repairs, there's always a kind of a grey line or an overlapping line sometimes with what falls as revenue, what falls as capital. You might replace a bathroom, for example. If it was to be categorised as a repair, it would need to be a like-for-like replacement. That doesn't mean you need to kind of replace the exact same suite. You know, if you're replacing an old dilapidated avocado kind of suite, it doesn't need to be exactly the same, but it needs to be generally kind of a similar standard to be able to qualify as a repair. There are a few exceptions where the like-for-like thing doesn't necessarily apply, and that's maybe where there's some kind of advancement in technology. For example, windows is a common one. You might have old timber single glazed windows that are kind of rotten. If you were to replace those with PVC double glazed windows, then you would get relief as a repair for that kind of expenditure. Key thing that we're seeing kind of in more recent years where people are making mistakes is regarding the finance costs. So if anyone's got a rental property, you'll be aware that this is kind of something that's been phased in over the last 4 years, and it's now kind of fully implemented. So instead of deducting any mortgage interest or kind of finance costs to arrive at your profit, you no longer do that. You get taxed on your profit before deducting that, but then you get a 20% tax credit at the end to reduce your tax liability. If you're a 20% taxpayer, in essence, this won't really have much of an impact in the total amount of tax due, albeit the way it's reported or presented to HMRC is different. And the way that figure might need to be rolled over can cause some kind of complications. If you're a 40% taxpayer, it will mean that your taxable profits, the taxable profits and the amount of tax you pay will go up. Another kind of point to mention as well is depending on the type of the property that you have, depends on the tax treatment as well. So when I mentioned the finance costs there, that's something that would apply to kind of your standard rental property. If you had a kind of a short-term rental, like something that you see on Airbnb, if you qualify for the conditions of what is called a furnished holiday lets, and there's various conditions that you need to meet to qualify for that. So that would be the number of days that it's available to be rented out for the year, the number of days it is actually rented out for the year. If you qualify for that, then you would get full relief on the finance costs, for example. You would also be eligible for things like capital allowances. So there's different treatments depending on the nature of the property, and a property can kind of move from one use to another use. So it's important that that can flag up a few complications, and it's just important to ensure that the kind of the correct treatment is applied. I think that slide there just kind of summarises some of the key points. So really, for it to be deductible as an expense in calculating your profits, it's got to be wholly and exclusively incurred for that property rental, and you've got to establish that it is revenue in nature, not capital. The types of the property there, again, that's just to kind of highlight some of the different treatments.
Thank you, Dane. Moving on to SDLT, there is a bit of a hangover from cases. Maybe you've gone into some tax planning in the past that failed, and the revenue are investigating those. We've also seen a number of cases where a limited company has been used to purchase residential property, and again, if it's in London or the southeast in particular, and you're over the limits, then not everybody has picked up on the issue that there's an extra 15% SDLT in that scenario, unless it falls into various categories of reliefs. So that's something, again, the revenue have been issuing quite a few enquiries and letters around, and they will issue penalties as well. We've been pretty successful in reducing penalties, but unless you fall within the particular reliefs, then there may be an extra SDLT charge there too. And another area that we're seeing quite a lot of cases on SDLT is mixed use property. So if you've got land or property that has both a commercial use too, then there is a risk that the SDLT rates that have been used may be incorrect. There's also the scenario of if you're buying more than one property at the same time and they're linked, and you're averaging the SDLT across the properties, and again those calculations may be incorrect, and Ex-HMRC are picking up those enquiries and investigations into SDLT too. You might think it's a tax that doesn't get too many inquiries, but there is a team in the revenue that deals solely with SDLT, and over the last few years, especially with the property boom, no doubt if you've not got those correct, you need to just revisit those, I would suggest now, before the revenue open inquiries, which no doubt they're going to be busy over the next few years as well, picking up those recent transactions that have happened over the last 18 months with increases in property values and increase in the number of sales that have been happening. There's bound to be more SDLT queries.
Thanks, Dave. Yeah, I'm just going to quickly cover ATED, which, for those of you that don't know, stands for Annual Tax on Enveloped Dwellings. It's essentially a charge, an annual charge that's applied to any UK residential property. So it has to be residential, not commercial. UK residential property valued at more than £500,000 that is held by a non-natural person. So it's held by a company or a partnership where one of the partners is a company. Then it would trigger the ATED charge. The charge it runs from 1st of April to 31st of March. It's an annual charge, and you're meant to file in advance. So you have to file your return between 1st and 30th of April for the year ahead. Obviously, if you dispose of that property partway through the year, there would be an adjustment. Or if you acquire the property within the year, you have 30 days from acquisition to file that return. There's various bandings for the annual charge, depending on the value of the property. For the coming up year, so from April the 1st, 2022, the highest charge is £244,000 a year. That's for properties valued at over 20 million. And the lowest category is 3,800. That's for those valued between 500,000 and a million. And it kind of goes up in stages between those two amounts. There are various reliefs, and ATED wasn't introduced to try and catch out or charge people that have acquired property in corporates to use as a rental business or develop as part of a property development business. So there are reliefs that would discharge that liability or that annual charge in full, providing they apply. You still have to file a return, though. That's an important thing. You might think that there's no charge, therefore you don't need to file a return, but you still do. And there are late filing penalties if you don't. The late filing penalties are fixed charges essentially, but again, I think it's a fixed fee of £100 if you miss the deadline, and then at 3 months if it's still outstanding, it's a flat rate, a daily rate. Then at 6 months and 12 months, it's similar. I think a £300 penalty. If there is a charge, for example, if you don't qualify for one of the reliefs, then you would get a tax geared charge in addition for any late payments. So it's not just the late filing that you get penalised for, which becomes tax geared where there's a liability, but the late payment one as well, which is generally 5% of the amount due, and that applies kind of at various stages throughout the year. I think it's a month, 6 months, and 12 months. So it's really important that if you are, you might hold this property commercially. You might hold it as part of a rental business. You might not have an ATED liability. You still need to kind of identify that it kind of hits those kind of conditions at the top, and if it does, file a return in advance.
Thank you, Dane. I've just got a question from someone in the audience who says that they can't hear their volume, but I think that's just an issue for your own laptop, your own PC or mobile phone, depending on what you're watching this for. We're not aware of any other problems with the volumes, and there's no other settings that we can make with regard to volume. I think it probably is just your own laptop. Hopefully you can sort it out. You can pick up the recording of this if you struggle with that volume now and want to revisit us from the beginning. You will get a link to the recording. Our final point then, this has been a Whistlestop high-level review of property issues, disclosures and problems with property portfolios and income. And one of the issues that we're seeing, again, quite frequently at the moment is the private residence relief. So you may think that if you're selling your own home, that it's wholly exempt from tax. That depends on whether it actually does qualify as your main residence or not. If you've got more than one property, you may have made incorrect declarations for which property is your main residence. Equally, you may struggle to find evidence to support that it's been your main residence. And we have seen cases where HMRC have challenged that. So the more evidence you have, the more documents you've kept, the better. To be able to prove that that was your main residence. Otherwise, there can be challenges by HMRC. Equally, if it's not just around a second home or a number of homes that you've had, and whether it qualifies as a main residence, the other issue that we're seeing as well is whether actually part of the land also qualifies. Normally, only half a hectare is within the exemptions. Anything more than that, the revenue may say it's not part of the normal enjoyment and part of the property of the part of the land associated with the house. It's not just a nice garden, a nice big garden. Actually, it's not exempt, and the revenue may look to apportion and charge a gain on that. There have been some cases through the courts, tax tribunals on both these issues around main residence, around whether a garden or land qualifies with the exemption. The cases are usually fact specific, so not necessarily setting in massive precedences. So again, it's important to get the facts straight, take advice if you've got an inquiry, keep records and documents if you're buying and selling property. Also, just as a quick reminder, the rules for capital gains on selling property for residential property, you do have to make a return and pay the capital gains tax within 60 days of the completion. It was 30 days, but that was extended in the autumn budget last year to 60 days. Those 60 days can soon disappear. It's very important to declare the gain and pay the tax, or get a time to pay on the tax if that's necessary. Otherwise, you'll be facing penalties and surcharges for late returns. The liability has to be as accurate as possible. Adjustments can then be made to the capital gain return and or in the self-assessment return, depending on the circumstances. It still has to be included in the self-assessment return, but the tax is paid through the capital gains return process. It can be a bit messy if you're an agent dealing with it on behalf of a client as well. So as we can see today, there are a lot of risks with property, both in rents and selling, complications if you own it through a company with SDLT and ATED issues. We would always say advice before submitting returns, take advice when you've got the property, take advice before selling, to doing tax efficient Jamal. Property portfolios. Do contact us if you need a consultation or advice around that. Do contact us if you need to make a disclosure to HMRC, or if you're facing an investigation by HMRC into property or any other issues. Do please contact us. Contact me at Churchill Tax Advisors and Dane as well. You can look us up on the web. Obviously, you've got our access through the email addresses that we've sent. Other than that, thank you very much for joining us today. Thank you for watching the recording, and please join us next month for another investigations webinar update.
Thanks everyone. Cheers.
Bye. Bye.